Hey, good afternoon, everyone. Uh, my name is Alok Vasant. Welcome to the first webinar that we are hosting on capital markets. A very interesting topic, and I think over the last 5 years or so, India has seen a lot of action on the capital market side, and we at AccuPro Consulting have been fortunate to be involved in that process, which a lot of startups have now have come of age and have now realize their dreams of getting listed on the Indian stock exchanges. And this is a very, very significant phenomena that we're witnessing. On every other day, you'll hear that one or the other startup is now going the listing route. So my intention today is that we walk you through the essentials of an IPO, what it really means, how the process works, what are the legal and financial aspects involved, and also obviously some real world scenarios and that we've seen in the recent years. So the idea is not to go too deep into theory, but to share a clear and practical understanding of what it involves, so that anyone who is looking to go that route has a basic idea as to what needs to be done. And we have very distinguished speakers with us, my partners Balwan Bansal and Ankit Jain. Just a small introduction about Balwan and Ankit. Balwan is a co-founder of AccuPro Consulting. So we had started this 15 years back. He's a seasoned finance and regulatory advisor with nearly 2 decades of experience in tax, accounting, and corporate consultancy. He's been leading the IPO practice in our firm. And so after early managerial roles at Deloitte and EY, he's laid the foundation for AccuPro Consulting and is driven by his vision of high growth to support businesses, startups, and foreign funded entities. So I'm sure he will be able to share a lot of insights on IPOs, the IPO route, and feel free to ask questions from him. So I think that's where we will all benefit from his experience. And then we have Ankit. Ankit is a partner at AccuPro Consulting, seasoned chartered accountant and a finance professional with over a decade of experience in accounting, assurance, and capital markets, specializes in IFRS and NDS. And he's helped to share AccuPro's strategic direction in financial compliance, capital markets support, and advisory offerings. And especially has been helping clients with their IPO readiness and plays a very, very important role when startups are preparing their DRHPs. And so over to you, Balwan. I think we'll have a very interesting session and a lot of us will benefit from your experience. So over to you, Balwan.
Thank you so much, and good evening, everyone. As Alok mentioned, we will talk about one of the most defining moments in a company's journey, the IPO or the initial public offer. It is not just a financial event, it's a strategic leap, one that can shape a company's future, reputation, and long-term value. Over the next 1.5 hours, we'll explore some of the key questions. What you should know to start an IPO journey, whether you are a founder, a CFO, or a professional advisor. Why does the IPO matter beyond just raising capital? And more importantly, what is the process of an IPO? Whether you are a founder, a professional, or an advisor, understanding the process deeply is crucial because every IPO is more than a transaction. It's a story worth telling. Let's dive in by asking a simple question. What exactly is an IPO? An IPO is an event when a company offers its shares or convertible securities to the public for the first time. This is the moment a company moves from being privately held to being listed on a stock exchange. From that point on, everyone can buy and sell its shares in the open market. Now, an IPO is not one size fits all model. It can take different forms depending on the company's goal. The first is fresh issue. This is when the company issues brand new shares to raise capital. That money typically goes into growth, maybe to expand into new market or to invest in new technology or to repay debts, or hire new talent. The second is what we call an offer for sale, or OFS. In this case, existing shareholder, usually promoters or early investors, sell a part of their holding to the public. No new shares are created, but ownership changes hands. And uh, and then there is combination of both fresh issue and OFS. This is actually the most common structure where both the company and the early investors benefit. Now, for something to truly qualify as an IPO, two conditions must be met. One, company must be unlisted before the offering, and the offer must be made to general public, not just to a select group. This ensures accessibility, transparency, and broad-based participation. All of them are hallmark of a healthy capital market. Now I'll move to the next question. What are the key advantages of an IPO? Why would a company go public? I think the better question may be, why not go public if the company is ready? At first glance, the obvious answer to the question why a company would go public is to raise capital. And yes, that's the big reason. But it is not the only one. And in many cases, this reason is not even the most important one. Even when a company does not need fund urgently, an IPO can still be a strategic and game-changing moment. It's a moment that reshapes the company. It reshapes the company financially, operationally, and even emotionally. The first, in fact, the IPO opens new doors, not just to the capital, but to the partnership, visibility, better governance, and long-term value creation. Going public is more than a transaction. It's a milestone, a message to the world that company is ready for its next big chapter. Let's now look at some of the specific advantages one by one. Let's start with one of the most fundamental reasons for a company to go public. The reason is access to capital. When a company launches an IPO, it's not just listing its share on an exchange. It's opening a new chapter, a chapter that gives access to large pool of capital from public markets. This capital becomes the fuel for the next level of growth. The funds raised through an IPO, especially through a fresh issue of shares, are generally used strategically. Companies use this capital to expand into new markets, to build new products, to invest in R&D, or to simply pay off debts and to strengthen their balance sheets. It gives them the financial muscles to scale faster, to act on an opportunities, and to build their competitive edge. It is also important to note that when company grows, they don't grow alone. They create jobs, they enable industries, they contribute to innovations, they generate tax revenues, they inspire the next generation of entrepreneurs. And yes, capital is the immediate benefit. But the bigger impact of the capital is nation building. I repeat again that the bigger impact of that capital is nation building. When a company raises money through a primary issue, it has to clearly spell out the object of the offer in DRHP. And when we look at IPOs across sectors, the objects usually fall into four key areas. The first is capital expenditure, whether it is for setting up of a new manufacturing plant, or for opening new stores, or for investing in infrastructure. Second is working capital. Companies often need more funds to support increased operations, inventories, or receivable as they scale. Third is debt repayment. The company raise funds and funds to reduce interest burden and improve financial ratios. Fourth is identified acquisitions, where part of the proceeds are used to acquire another identified company, technology, or intangible property. But that's not all. We have seen companies like Aether Energies, Mamaearth, MobiKwik. They raised fund for growth-related expenses, including advertisement, marketing, sales promotion, R&D, and technology-related expenses. These are the investments that build long-term brand equity and that fuel the product innovation. Under SEBI guidelines, companies are allowed to allocate up to 25% of the amount being raised by the company towards general corporate purposes. This gives them the flexibility to respond to evolving business needs. However, if the company wants to pursue unidentified acquisitions in future, the company is allowed to allocate up to 35% of gross proceeds towards general corporate purpose and unidentified corporate purposes. So while capital is headline benefit, strategic use of that capital makes an important transformative, not just for the company, but for the economy as a whole, for the industry, and for the larger ecosystem that company touches. Another powerful outcome of going public is the corporate discipline and governance that it brings to the company. Once listed, a company does not answer only to few private investors. It is answerable to the public. That means stricter regulations, mandatory disclosures, and strong board oversight. Public companies are required to follow governance norms like having independent directors, regular audits, and transparent financial reporting. This creates a culture of compliance, sharpens internal controls, and builds long-term accountability across all levels. In many ways, going public forces the company to grow, to act like a responsible corporate citizen, and the culture often sets the tone for sustainable ethical growth, something that benefits not just investors but the entire ecosystem. IPO also enhances credibility. Listing on stock exchange instantly elevates a company's public image. It's a powerful signal. It tells the world that the company meets strict financial, regulatory, and governance standard that builds confidence, not just with the investors, but with the customers, business partners, and even the employees. People trust listed companies more because they know that the listed companies are more transparent and more accountable. It also positions the company as a leader in the industry, not just locally, but globally. Whether it is attracting global clients, strategic partners, or top tier talent, being listed gives a business credibility and visibility that private company often struggle to achieve. I'll move to the next benefit, which is liquidity for existing shareholders. When we think about an IPO, most people imagine it is only about raising fresh capital, but that's just one part of the story. So going public is equally, if not more, about unlocking liquidity for those who haven't been part of the journey from the very beginning. Think of the founders who have built the business brick by brick, the early investors who backed the idea before anyone else did, and even employees who have earned ESOPs along the way. For all of them, listed changes everything. Suddenly, shares that were once just paper certificates now has a real and visible market value. These shareholders can sell a part of their holding not to exit the dream, but to diversify, reinvest, or secure their future. Now let's understand how companies are structuring IPOs today. If we look at the data for the financial year 24-25, over 80% of the IPOs involved an offer for sales. That's the strong indication that IPO market is being used as a tool to create liquidity, not just a tool to raise fresh money. Here is a snapshot. 13 IPOs were purely fresh issues, raising about 15,000 crores. 14 IPOs were purely OFS, raising nearly 59,000 crores. And about 52 IPOs were a combination of both, raising massive 89,000 crores. In total, 1.62 lakh crores were raised through 79 IPOs, and the majority of that came through OFS. So the takeaway is clear. IPOs are not just fundraising events. They are structured liquidity events. They allow promoters and the early stage investors to realize the value that they have created while giving a chance to the public to participate in the next phase of growth. So I'll move to the next benefit now. The other benefit is the enhanced prestige for the founder. For a founder, taking the company public is deeply personal. It is not just financial milestone. It is a moment of recognition. As IPO says to the world, the founder has built something that matters. It validates the years of rest, sacrifice, sleepless nights, and belief. Going public gives the founder a place at the table among market leaders, innovators, and change makers. It brings credibility, visibility, and influence. More importantly, it is the start of a new chapter where the founder is no longer just building a company, but shaping the industry and inspiring the next generation of entrepreneurs. Another benefit of going public is that founder is no longer guided by just few investors. When a company goes public, everything changes. The founders are no longer guided by just a few investors. They answer to the public, to the thousands of shareholders, to the mutual funds, to the big institutions, and to the people who believe in the company's mission. This brings freedom and responsibility. Now, the founder does not have to follow the agenda of handful of voices. They can take decisions for long term, for the greater good, and for the broader market. It's about serving many, not just a few. That's what real leadership look like. One of the major overlooked but powerful benefit of IPO is how it changes the perceived value of company. Before listing, your company is usually seen as its net worth. That's what banker and lender look at. But after an IPO, it is the market that decides your value. That's based on your market capitalization. And market cap is usually much higher than the net worth. I'll take an example. The average price to book value of Nifty 500 companies is over 3.5. That means if your net worth is rupees 100, your market cap could be rupees 350 or more. One of our founder once joked that I'm not handing over my children rupees 2000 crore company. I'm handing them over 8,000 crore legacy. That's the difference between net worth and the market cap. An IPO brings transparency. Your valuation becomes visible to the world and allows investor to benchmark you against other listed peers. This comparability increases investor trust and opens door to more strategic partnerships, better financing terms, and long-term growth. So let's talk about another key benefit of an IPO, that is market valuation and benchmarking. Before listing, a company's value is often seen as its net worth. Yeah. I think, yeah. So another benefit of an IPO is easy hiring of the top talent through IPOs. Public listed company can offer stock-based compensation to attract and retain top talent. When a company is listed, the perceived value of its shares increases. In fact, the same benefit extend to when you are going to acquire a new business or you're going to acquire any other company. Once a company is listed, its shares become a powerful currency. Public traded shares can be used in mergers and acquisitions. The acquisitions are through share swap deals. This allows a company to pursue inorganic growth without needing cash. It makes acquisitions faster, leaner, and often more cost effective. We have seen this in action with several of our clients. RHI acquired Dalmia Refractories through a share swap deal. Unicommerce, after listing, acquired Shivway in a similar structure. Zomato acquired Blinkit in a major share swap deal. One that fundamentally reshaped its business model. These are just a few examples. Such deals are increasingly common in listed space. And what we have seen is clear. Being listed doesn't just improve your brand or valuation. It gives you a whole new toolkit for driving strategic growth. These advantages make IPO process a strategic inflection point. The IPO helps companies to scale up, institutionalize governance, and build sustainable value over time. Now we'll move to the next question. So the next question is, who can launch an IPO? This is one of the most common questions we get. A company can list on stock exchange under two separate routes prescribed by SEBI. One is the regulation 6.1 and the second is the regulation 6.2. These are mutually exclusive. Either you fall under regulation 6.1 or under regulation 6.2, not under both. Let's first understand the eligibility conditions under regulation 6.1. This is the traditional route and is based on the assumption of strong financials. So the first condition is in respect of net tangible assets. The company must have at least 3 crore of rupees of net tangible assets. I repeat, the company must have at least 3 crore of net tangible assets. This is calculated on restated and consolidated basis, and in each of the past 3 financial years. There is another condition that cash or the monetary assets should not exceed more than 50% of these assets. This ensures real business substance, not just money in the bank. There is one exception to this 50% rule. If the IPO is only in OFS, the 50% limit on cash doesn't apply. Now you may ask a question, what are net tangible assets? It's simple. Total assets excluding intangible items minus total liabilities. Let's talk about the condition number 2, which is about consistent operating profits. The company must have earned average operating profits of at least 15 crores in the last 3 financial years. And it must have reported operating profits in each individual year. This is to show that the business is not a one-hit wonder. That's a stable, profitable engine behind the company. Condition 3 is about minimum net worth. The company should have a net worth of at least 1 crore in the past 3 years. This confirms financial strength and the capital base. And the fourth condition is about name change check. If the company has changed its name in the last 1 year, it must show that at least 50% of its revenue now comes from the new business. This is to avoid misleading. Investors with flashy name changes. Let's now come to a common question. How did companies like Zomato and Paytm go public if they were not profitable? And the answer lies in regulation 6.2, which is called alternative route. This route is designed for companies that do not meet the eligibility criteria under regulation 6.1. For example, the company do not have enough profit history. The company has lower net worth, or the company does not have enough net tangible assets. Think of it as the high growth early stage route, but it comes with 2 important conditions. The first condition is that the IPO must be done only through the book building method. This is simple condition since most of the IPOs, even otherwise, are through book building method. That means a price band is set and investor bid within that range. The final price is discovered based on demand. I'll talk about the condition 2, which is an important one. The condition 2 is about 75% QIB participation. At least 75% of the net offer must be allocated to QIB. QIBs are institutional investors such as mutual funds, insurance companies, etc. So what's the impact of applying regulation 6.2 instead of regulation 6.1? The answer is, if you go through regulation 6.1, it allows the IPOs to be more broadly distributed. QIBs can get maximum up to 50%. Retail investor would get minimum 35%, and HNIs would get minimum 50%. This is a balanced participation. On the other hand, if you go via Regulation 6.2, it puts price discovery and allocation power mainly in the hands of institutions. Retail and HNI investor get a much smaller allocation window. This route is less flexible. If 75% of the QIB's portion is not subscribed, the IPO fails and money is to be refunded. However, new age companies has to go through this route. They are fast growing, but they are not yet profitable. They have to go to QIBs for at least 75% of the subscriptions. So by meeting these two conditions under Regulation 6.2, companies like Zomato, Paytm, and others launched IPOs even though they were not profitable. To summarize, both Regulation 6.1 and 6.2 are valid paths to public market. But knowing what path you can take and why is the first step in the IPO journey. I'll talk about like few of the eligibility criteria specified by NSE and BSE, right? So NSE requires a minimum post-issue paid-up capital of rupees 10 crores or more, and also it requires a maximum minimum market capitalization of 25 crores, right? And like the company has to comply with the Companies Act, SEBI Act, SCRA, and other regulations. The company must have at least a track record of 3 years. And yeah, so these are like major conditions, major eligibility criteria specified by NSE. Let's move to the next question. Who cannot make an IPO, right? What are the disqualification as per ICDR regulations? Generally speaking, debarred entities or entities associated with promoter or directors of debarred entities with promoter or director who are willful defaulter or fraudulent borrower or fugitive economic offenders are not eligible to go public. I'll talk about another important condition for an IPO. Anyone should not have any right convertible into equity shares against the company. So at the time of an IPO, no one should have any right convertible into equity share against the company. The company must convert all fully paid up convertible securities before filing of RHP. It means that fully paid up CCPS and CCD can be there at the time of filing of DRHP, but the same must be converted before filing of RHP. There is an exception. Exception is that ESOPs, because ESOP is a right convertible into equity shares, can still exist, right? If the ESOPs, the condition is that ESOP must meet the regulatory requirement under Companies Act. So this completes the eligibility criteria. Now I'll move to the next question, which is like, what is the process of an IPO? As we have discussed, an IPO is not just an event to raise money. It is a transformational leap. It pushes a company into public spotlight, where it is now accountable to market forces, investor expectation, and strict regulatory standards. But getting there is not simple. The IPO journey is multi-stage process that stretches across several months and involves multiple stakeholders, from promoters to advisors to regulator to investor. Before discussing the process of IPO, I'll talk about intermediaries involved in an IPO process. So no IPO can succeed without the involvement of well-coordinated set of professionals and institutions, commonly known as intermediaries. These intermediaries play a crucial role at every stage of IPO, from drafting the offer document, collecting funds, ensuring legal compliance, and to facilitate listing and allotment. Let me now take you through the key intermediaries involved in IPO, what each of them contributes. So first is merchant bankers or book running lead managers, or we simply call them bankers. At the heart of the IPO process is the merchant banker, more formally known as the book running lead manager or BRLMs. They are registered with SEBI. They are mandatory for an IPO. The merchant bankers are company's primary advisor and coordinators throughout the listing journey. They are responsible for preparing and filing the DRHP and managing communication with SEBI and stock exchanges. They guide the issuer through complex regulatory and pricing decisions. The merchant bankers also plays a central role in conducting due diligence, market research, and determining the price band for issue based on investor feedback. In essence, they are the strategic lead of the IPO team. The second important intermediaries are statutory auditors. They are responsible for auditing RFS that goes into DRHP and RHP. They ensure that RFS are prepared in accordance with the accounting standards and SEBI requirement. Their audit increases the reliability of financial statement in RFS, and this audit is required under ICDR. Then another important intermediaries are independent chartered accountants. They are responsible for auditing financial and operational information proposed to be included in DRHP other than RFS. Further, they verify all the relevant financial, operational, secretarial, and contractual information and issue certificates in respect of compliance with the regulations such as corporate governance and in respect of disclosure relating to several matters such as capital structure, ESOP, tax litigations, material subsidiaries, etc. They issue these certificates for the reliance of the bankers and for inclusion of the information in the offer document. Their certificates lends credibility to the company's performance and is critical for the investor confidence and for bankers' due diligence. Now I'll move to the next intermediary, which is legal advisors. Every IPO requires careful legal scrutiny. That's where the legal advisor steps in. Though they are not regulated in the same manner as merchant bankers are, but legal advisors play a pivotal role in conducting legal due diligence and ensuring that the company complies with all applicable laws. They review litigation matters, corporate records, contractual obligations, and assist in verifying the disclosures made in the offer document. Legal advisors also help in drafting key agreements, declarations, and undertakings that are part of IPO documentation. So, like in case of legal advisors, it is a three-way coordination, right? So basically, there are three corporate law firms that are generally engaged. One is company counsel, second is banker counsel, and third is international counsel, right? So what company counsel does? Company counsel play a critical role in an IPO process. Their responsibility include guiding the company in preparing key documents such as DRHP. They also ensures that company follows proper corporate governance practices, makes accurate business and financial disclosures, and complies with all necessary regulatory requirements. This includes working closely with company to meet the standards set by SEBI, ROC, and the stock exchanges. Now let's talk about bankers' counsel. The legal advisors appointed by the banker also play an important role in the IPO process. Their job is to carefully review the offer document. They are responsible for complete due diligence on the company on the behalf of bankers, and to make sure that the underwriting and syndicate agreements are fully in compliance with the regulatory requirement. They also verify that the investor protection mechanism are legally compliant and properly structured. Now I'll move to the third concept, which is international counsels. In case where IPO involves foreign investors or an overseas listing component, international legal counsels are brought in. Their role is to ensure compliance with the foreign security laws, such as regulations set by US SEC or European authorities. They also support cross-border due diligence, assist in marketing the IPO to the foreign qualified institutional buyers, and help coordinate the necessary disclosures for the international investors. Now let's talk about the other intermediaries. An important intermediaries is project manager or the PMO. A project manager plays a critical role in IPO journey. They provide in-house expertise to the company and add much needed bandwidth to the company's IPO team. In many cases, the internal team of the company may not have prior IPO experience. That is where the project manager steps in, closely working with the internal team and coordinating with the external stakeholder. Their job is to ensure that tasks are completed on time, gaps are addressed quickly, and everyone stays aligned. To meet tight IPO timelines and reduce friction, having a strong project management office is not just helpful, but it is essential. I'll move to the other important intermediary, which is industry report agency. And an industry report agency is an important part of DRHP. This report is commissioned from an independent research firm. This report helps investors position the company in the broader context of its sector, benchmarking its size, growth, competition, and market potential. It adds a layer of credibility to the company's narrative, especially for the first-time public investors. There are few more intermediaries. Those are important. They are registrar, collecting banks, DPs, and like advertising and PR agencies, printers, monitoring agencies, and so they also play their part in the IPO journey, right? And in fact, I would like to touch base on the stock exchanges, right? Stock exchanges such as NSE, BSEs are the platform where shares are ultimately listed and traded. But even before the listing date, they are involved in granting in-principle approvals for IPO based on the DRHP and company credentials. Once the IPO is completed, exchanges monitor listing compliances, coordinate with the registrar for allotment, and ensures that all post-listing disclosures are made as per SEBI listing regulations. The listing ceremony at the stock exchange may be last for a day. So listing ceremony just lasts for a day, but the regulatory relationship with the exchange continues infinitely. So these are like we have discussed about the intermediaries. Now let me walk you through the full full IPO life cycle. And this life cycle is from early stage planning all the way to listing. And along the way, I'll talk about a few of the practical insights on each step. So first step or first phase, we call it preparatory phase. And we say preparatory phase is before there is a formal kickoff. So when a company starts thinking about going public, the very first step is what we call preparatory phase. And it typically began 2 to 4 months before the formal IPO process kicks in. This is the moment of truth. It is the phase where company must seriously evaluate, are we truly ready for a life as a public company? Are we prepared to operate with discipline, governance, and transparency that the public market demand? Because an IPO is not just a transaction, it's a transformation. This phase sets up the foundation structurally, financially, and operationally. What are the major steps that needs to be taken care of in a preparatory phase? Let's discuss that. So first is the company must assess whether its current structure is suitable for listing. This includes examining its group structure. Sometimes a particular business unit sits outside the core group and needs to be brought in. On the other hand, it may happen that certain non-core assets may be lying in the company and they need to be carved out before the company goes public. Second is basically around agreements with the stakeholders, especially you have agreements with investors and joint venture partners. They may need to be renegotiated or terminated. This is often sensitive but very crucial because such rights may not be compatible with the listed environment. Shareholder patterns may also need to be cleaned up. For example, where investor holds unusual right, or where shareholder does not comply with SEBI ICDR regulation, this is the time to align with those regulatory expectations. Soft approval from shareholder are usually taken to prepare for restructuring. Now I'll move to the third step in the first phase, which is the preparatory phase. So the third is about the financial preparation. The company also begins benchmarking its business. The company start preparing a list of competitors and start collating data around the data matrices and the KPIs that the other companies in the industry are tracking and disclosing. This include identifying listed peers, understanding their operating and financial metrics, and figuring out which disclosures investors expect. The ICDR regulation require a disclosure of all the KPIs that has been disclosed to the investor at any point of time during the last 3 years preceding the date of filing of DRHP. Also, it is required to check if the financial statements are prepared under Ind AS. If they are not prepared under Ind AS for any of the last 3 years, they need to be converted as per the requirement of Ind AS. If the auditor does not meet the eligibility criteria for IPO bound companies, a change may be required. Further, internal controls must be strengthened to ensure that the company can withstand public scrutiny. Now I'll move to the fourth step of the preparatory phase, which is internal readiness. So governance standard needs to be elevated because now functions like finance, legal, company secretariat take central stage. They are no longer back offices. They are now the face of compliance and credibility. The company begins to review legal and secretarial documentation, ensuring that all applicable laws and regulations have been complied with. Generally, companies go for a legal and secretarial audit to find out the known compliances, if any, through an external or an independent consultant. In case any non-compliance is identified, the consultant advises you on the remedial actions. If there are any lapses in the past, the company takes steps to clean up its reports. Sometimes the company may need to go to the regulator and file an application for compounding of non-compliance or for compounding of an offense. This is critical step. The company cannot go public with material non-compliances. Therefore, the company wants to ensure that non-compliance, if any, is identified early and is corrected at the earliest. We have seen that non-compliance is identified at a later stage, delayed the filing of DRHP sometime by a quarter because rectification of non-compliance may take several weeks. These delays lead to substantial increase in IPO costs. Another action that needs to be taken is like we have to start collation of data and the documents. So the company start preparing data room, collating agreements, licenses, board minutes, financial documents. The company knows that detailed due diligence will follow soon. The company undertakes a review from the perspective to ensure that the company has complied with all the relevant laws and regulations. Based on the aforesaid preparation, one key decision needs to be taken: when to file the DRHP. Filing DRHP is the crucial milestone in the IPO journey. To determine the tentative date of filing DRHP, we must first decide which financial quarter's result will be included in the DRHP. The DRHP must be filed within 135 days from the end of the chosen financial quarter in case shares are offered to US institutional investor. DRHP can be filed within 180 days from the date of chosen financial quarter end in case the shares are not offered to the US institutional investors. This means, I'll take an example. If you are using September 2025 results, the DRHP must be filed by mid-Feb 2026. But before that, two important steps must be completed. The financial for the quarter must be audited and all relevant data must be updated in the DRHP. If a company's internal financial processes are still maturing, just getting the quarterly audit done may take 45 to 60 days. This leaves with very little time for DRHP drafting and internal reviews. If you miss this 135 days window, you cannot use that quarter's number and must wait for the next quarter to get closed and get audited. This could delay the IPO timelines by 3 months or more. And that comes with cost over in terms of more advisory fee, more holding cost, and lowest opportunity cost in the market. So deciding the right quarter and planning the DRHP filing date backward is one of the most important decisions in the IPO journey. And finally, when you have decided the tentative date for filing DRHP, now you start meeting with the merchant bankers and you start aligning on the expectation, not just on the process, but also on the valuation of the company. The first conversation around valuation begins here. The company also begins appointing its other advisors and experts, such as legal advisors, project manager, auditors, independent chartered accountants, industry experts, registrars, etc. And the company also forms an internal IPO committee. So in summary, the first phase, which is preparatory phase, is all about cleaning the house, building readiness, and laying the foundation, structurally, financially, and operationally, to be a listed company. The real works begin here, because once this phase is done right, the rest of the IPO journey becomes much more smoother and far more effective. So I'll talk about like other second phase, which is due diligence and SEBI filing. So like in this phase, DRHP is the most important, right? Think of DRHP as company's introduction to the market. So it is the DRHP is scrutinized not only by the potential investors but also by SEBI, and accuracy and completeness is absolutely not negotiable. And how do you start working on DRHP? So first you build a virtual data room, right? Where you put all the documents, contracts, licenses, and like financial reports. And you start working on your like corporate governance structures. You align the board you align the board as per ICDR requirements, and you form key committees such as like audit committee and like nomination and remuneration committee. And you also, take necessary approvals like board approvals, shareholder approvals, and you also start, like other actions such as like increasing the authorized capital, amending AOA, and like converting the company from private company to public company. And you also start finalizing the structure and timing of the offer. On financial side, you start restating financial statements and getting them audited. And you prepare major policies like ESOP policy, dividend policy, material creditor policy. And at this stage, like you uh, decide and disclose information about key stakeholders such as promoters, promoter group companies, KMPs, SMPs, board members, etc. Each of these individual entities are required to provide specific declaration, disclosure, and confirmation for inclusion in offer document. And finally, you get a industry report commissioned from an independent research firm. Once all the information is properly filled in, the company is ready to file DRHP. It's worth noting that the company that do their groundwork well in the preparatory phase often find this stays smoother and more predictable. So I'll move to the next phase where DRHP is now ready and we can file it with SEBI and the exchanges. So once you file DRHP, SEBI and stock exchange review the document. Generally within 30 days, SEBI and exchanges issues first set of queries, and company respond to those queries with the help of merchant bankers, legal counsel, and the advisors. And once that review is complete, SEBI issues final observation and require company to make certain changes in DRHP. And this process generally takes like 3 to 4 months after filing DRHP. So after the changes, the company generally file like updated version of DRHP, which is called UDRHP. After receiving go ahead from SEBI, the company proceeded to file RHP with ROC. Once the final documents filed with ROC, the company reaches at a stage for actual IPO launch. It like it might be behind the scenes, but it is the phase where legal precision, regulatory compliance, and flawless execution really come together to ensure that the offer can proceed smoothly. So I'm not touching based on this confidential filing route, though like this is being used nowadays. And then I'll just quickly cover marketing and deal structuring, which is like fourth phase, right? This is the phase which is goes simultaneous with the SEBI observation period, right? Where the merchant bankers and the company goes for the road shows and like analyst interaction and investor presentations, both in India and internationally, to raise funds or to educate the market and to generate interest. And the company gets the real-time feedback about the growth narrative, like how the investors are viewing the business and like what kind of valuation pricing they're willing to consider. Based on these feedback, in consultation with the banker, the company takes strategic decision about pricing the offer and deciding on the price range. Right. And during this time, the company converts whatever convertible instruments are there. So the CCDs and CCPs are converted into equity shares. Right. And then fifth phase is the pricing and launch. Company decide on the price, and then the offer is opened. That is usually for 3 to 5 days. And like and then like once this is subscribed, the issue is subscribed, Then we move to the next phase, which is allotment and listing. Right, shares are allotted to the eligible investors, and then the big day come, which is the listing day, and the company shares are officially admitted for trading on the stock exchange. It's often seen as the moment of celebration, with media attentions, investor enthusiasm, and even a ceremonial bell ringing. But while it marks the culmination of months of hard work, it is also the beginning of new chapter. From this day on, the company is no longer private. It is more accountable to much larger universe, public shareholders, analysts, regulator, and the broader investment community. This means maintaining high standard of governance, transparency, and investor communication is no longer option. It is part of being listed company. Because every decision the company takes can move markets, affect valuation, and shape its long-term perception in the public eyes. So yes, a listing is a milestone, but more importantly, it's a responsibility. So this completes the process of IPO. Now I'll request my partner Ankit to continue the discussion and shed light on some of the other critical aspect of IPO journey.
Right. Thank you so much, sir, for the insights. Good afternoon, everyone. Thank you for joining in for this webinar. So as we move deeper into the IPO journey, so what we have seen in our experience of working with IPO bound companies is that one of the most important areas, that companies deliberate on while preparing for an IPO is the aspect of promoter identification and promoter obligation, right? So identification of promoter and promoter group is one of the key aspects of any IPO that involves, multiple stakeholder discussions. And, in our experience, one of the most debated and long lead items in an IPO journey. Although in today's discussion, we're not covering the aspect of promoter identification. However, we're going to touch upon a few requirements of ICDR regulations in relation to promoters. Among these, minimum promoter contribution and promoter share lock-in provisions are some of the key regulations that I'm going to discuss in the next 15-20 minutes. But before we dive deep into these requirements, let's first briefly understand who promoters are as per ICDR regulations. Now, both Companies Act and ICDR regulations have defined promoters as a person who is named as a promoter in the prospectus or offer documents, or has been identified as such in the company's annual return. A person who has control over the company's affairs, directly or indirectly, as a shareholder, director, or otherwise. And a person on whose advice, directions, or instructions the board of directors of the company is accustomed to act. So, in summary, the identification and obligation of promoters and their promoter group entities requires very careful consideration by all stakeholders. So, as we've seen, both Companies Act and SEBI ICDR regulations set clear, stringent criteria for recognizing promoters, ensuring that those with significant influence, control, or guiding role in the companies are rightfully identified is a very important aspect of promoter identification. This clarity is essential not just for compliance, but for creating transparency and investor trust as well. We have seen, that SEBI generally scrutinizes this aspect very, very critically while reviewing offer documents or clearing documents, and seek a lot of explanations from companies in respect of identification of promoters. So again, to iterate, I would like to highlight that companies planning to go for an IPO in a very near term, let's say 6 months to 1 year horizon, should be very, very careful in filing their annual returns and financial statement disclosure with respect to promoters of the company. We've seen a lot of companies struggling with incorrect disclosure in their annual return. So yeah, I think this is one aspect I would like to highlight. Now, with this brief understanding, we can now turn our focus on some of the key regulatory requirements relating to promoters under ICDR regulation, namely the the minimum promoter contribution and the promoter shares lock-in provisions. Now, these are these areas carry significant implications for both company and its promoters, especially in terms of investment commitment and post-IPO responsibilities. Now, let's explore these regulatory provisions and understand how they impact the IPO journey. Let us, first understand the concept of minimum promoter contribution. Now, one of the core obligations of promoter, identified by any company. So, under the regulations, it is mandatory for promoters to collectively hold at least 20% of the post-issue capital of the company, which is calculated on a fully diluted basis. Now, this threshold is non-negotiable and regardless of the market dynamics or internal structuring, the rule must be complied with for a company to proceed with its IPO. Now, what we've seen is that this can sometimes be very challenging, particularly for new age or venture funded companies, right? So what happens is in these cases, founders who are identified as promoters may find that by the time the IPO is planned, or by the time they are planning to hit the market, their own shareholding has been diluted to a sub 20% mark, right, due to multiple rounds of fundraising. However, SEBI regulations allow some flexibility here. So let's say if the promoter's direct holdings falls short, the balance can be made up by other eligible investors, such as venture capital funds or AIFs or financial institution, who then agree to obviously a lock-in similar to the promoter's own contribution. So about this lock-in, we'll just discuss in a little while. So the key message here is that meeting this 20% post-issue capital threshold is a fundamental prerequisite, right? So companies should monitor their cap table very carefully as they approach the IPO, and proactively plan for promoter contributions to avoid delays or last-minute restructuring. This requirements underscores SEBI's focus on ensuring that promoters remain significantly invested and aligned with the new investors as the company transitions into public market. Now, like I just discussed, let's say if the promoters on their own are unable to meet this 20% threshold, what happens then? Well, as per the regulations, the gap can be bridged by contributions from certain qualified entities, right? So these includes basically the investors on the cap table of the company, which could be the AIFs or the foreign venture capital investors or scheduled banks, insurance companies, let's say public financial institutions, or even some of the non-individual public shareholders holding more than 5% of the of the shareholders, as well as promoter group entities. So these entities can contribute up to a maximum of 10% of post-issue capital to help meet the shortfall of the 20% limit. So what happens when such shareholders contribute towards the minimum promoter contribution? Do they become promoters? Well, the answer is no. Their participation in such a case does not cause them to be classified as a promoter. However, the lock-in restriction with respect to promoters becomes applicable to them, right? So, and we'll discuss this. Now, the next question is, what happens if there are no promoters identified in any company? So, well, in cases where their company does not have a clearly identifiable promoter, or if the company, while evaluating this, is unable to find any person who can be identified as a promoter, such as a certain professionally managed or institution-led companies, then the 20% minimum promoter contribution rule does not apply. SEBI, however, is now scrutinizing these companies in more detail and insisting companies to identify certain specific persons to be named as promoters in offer document. Now, let's move on to the lock-in provisions. So, let's first understand like what lock-in means in context of an IPO. So lock-in, refers to a legally mandated period during which the promoter or the significant shareholders are not allowed to sell or transfer their shares after the IPO. This ensures long-term skin in the game and sends a signal of stability to the market. So there are two categories of lock-in, and based on the nature of the holding. The first is the lock-in or minimum promoter contribution, which we just discussed, so which is typically set at 18 months from the date of allotment of IPO. And this also applies to the portion of shares that counts towards statutory promoter contribution, usually the first 20% of the promoter issue capital. Now, in fact, like we discussed, if there are certain non-promoter shareholders who are contributing towards this pool of 20%, then even the similar lock-in period of 18 months apply to such shareholders as well, right? Let's say if the company has an object wherein it is raising funds for certain capital expenditure, then this period of 18 months 18 months increases to 3 years, right? So, and then the second category is the lock-in on excess promoter holdings, so which refers to the shares over and above the minimum 20% holding. So these are locked in for a shorter period of 6 months from the date of allotment. Again, in case there's an object which is a capital expenditure that the company is planning to do with the fresh issue proceeds, then this limit increases to 1 year. So, in conclusion, lock-in provisions and promoter obligations are not just legal checkboxes, right? They serve a bigger purpose. They reassure investor that the company's leadership is a long-term skin in the game and is committed to staying invested through the crucial early stages of public life. It's essential for promoters and companies to understand these requirements early in the IPO planning process to ensure compliance, smooth regulatory clearance, and most importantly, to build trust with the investing public. Now, moving on to the next topic of discussion is on the restated financial statements. Now, one of the most crucial activities of the IPO journey is the preparation of the restated financial statements, right? Or in short, we call it as an RFS, right? Now, these statements form the financial foundation on which investors, merchant bankers, regulators, or stock exchanges, base their evaluation of the company. Now, as per SEBI regulations, every company planning to go public must prepare restated financial statements for the last 3 financial years, and sometimes for an additional interim period, which could range from a quarter to half year to a 9 months period. These restated financial statements are included in the offer document as a separate section. The RFS preparation is, more than just a routine update. I would say it involves revisiting and, revising previously issued financial statements to correct any errors or inaccuracies, align accounting policies throughout the period, ensure compliance with and consistent application of current accounting standards and practices. The ultimate goal is to provide investors with a clear, consistent, and a transparent picture of the company's financial health and performance, enabling them to make a well-informed decision. So we have seen RFS are reviewed very, very critically by the merchant bankers and auditors, and undergoes multiple iterations and discussions. Therefore, this becomes a very critical activity in the entire IPO journey, and if not carefully planned and managed, may stretch the overall IPO timelines. So before we move forward, let's understand the purpose and need for restating previously audited financial statements. Now, when a company decides to go public, one question that often comes up is, if our financial statements have already been audited, why do we need to restate them? Well, I would say, think of it, the restated financial statement as a way of putting all your historical numbers on an even playing field, right? Over the years for which a company is, disclosing financial information in the offer document, a company may have followed different accounting policy, or, there may have been classification errors or inconsistencies from one year to the next. The restating brings every financial year in line with the current financial practices being followed by the company. So, and latest standards, accounting policy choices, etc. So the reader of the RFS or the prospective investor sees a clear and a comparable picture. Now, this process does, more than just, tidying up the books. It helps correct past significant errors in non-provision, harmonizes your accounting policies. Sometimes, it involves regrouping items, such as separating out non-recurring transactions to give investors a transparent view of the company's real ongoing performance, or regrouping certain expenses under different heads for better presentation and disclosure. Sometimes RFS also helps in presenting the impact of recent accounting pronouncements or latest standards, if being issued by MCA or regulatory bodies. Let's say there have been any modifications in the audit reports of the companies in the past, and which are quantifiable or can be estimated, have to be adjusted in the restated financial information in appropriate period. In situation where the quantification cannot be done of those qualifications or modifications, then the appropriate disclosures should be made in the notes to accounts, explaining why the qualification cannot be quantified or estimated. So, in a nutshell, the purpose and the need for restating previously audited financial statement is all about building credibility. By removing any room for confusion or misinterpretation, they help potential investors make more informed, confident decisions about the company's future and help them understand the financial statements better. Now, let's understand what periods an issuer needs to cover while preparing the RFS. So, as per ICD regulation, RFS must cover 3 most recent completed financial years along with a stub period. To help investors make informed decisions, regulators require that the financial information in an IPO offer document is up to date. Now, as per ICDR, if the financial statements for the most recent full financial year are more than 6 months old at the time of filing of the offer document, the company must also include a financial statement for the stub period. That is, the period from the end of the last financial year up to the date not earlier than 6 months before the filing. So I'll try to explain it with the help of an example. So in simpler words, the company's restated financials in the offer documents must always include financial information for a period ending within the past 6 months from the filing date, right? If this isn't the case, interim financials called stub period financials are needed to be presented for transparency. So let's say if there's a company A whose financial year ends on March 31, 2025, and the company plans to file its DRHP, let's say on November 30th, 25, the audited financial statement of March 31 are now older than 6 months from the filing date, which is 30th November. Therefore, company A must include a stub period financials for a period from, let's say, April 1 to 30th June, or maybe half year financials 30th September in the DRHP to meet the requirements of the regulation. The main goal is to avoid sharing outdated information and make sure that all the potential investors have access to the most current picture of the company's performance. Now, I'll touch upon some of the common restated adjustments that we see companies make in the RFS, right? The number one is prior period errors. So let's say there have been certain errors that have been occurred in the past financial statement, which may have slipped in the past and came to light in the IPO process. So the company is required to adjust those errors in the respective period in which those errors actually occurred, or maybe there would have been accounting for errors, and then you have to go and restate those financial statements back in the period when those errors occurred. And obviously, needless to say, those errors have to be material from the financial statements perspective. Change in accounting policy. Imagine a company decides to adopt a new accounting policy. Let's say it decides to change its method of depreciation from SLM to WDV. Then it needs to restate its prior periods to reflect the impact of such change in accounting policies, right? Impact of corporate structuring. We have seen companies, need to present RFS to include impact of recent corporate structurings. For example, in a very recent deal that we did, the company, was a standalone entity, but suddenly before the year end and 6 months before the filing, it acquired some of the group companies as a subsidiary, right, in a share swap agreement. So in such a case, what happened is suddenly it became a consolidated, a holding company in certain subsidiaries. So what it was required is in the RFS, it had to prepare consolidated financial statement for all the 3 periods of the RFS and include the financial statement of subsidiaries in the RFS for all 3 periods. So this is the kind of restatements generally we've seen. Share capital adjustments, a very common example of adjustments in RFS. So if there is a corporate event such as a bonus or a split, then the RFS needs to give the impact of such corporate actions. For example, the EPS have to be restated to include the impact of bonus and split. Right? There could be accounting reclassifications, regroupings. So when preparing RFS, it's important, not only to ensure accuracy but also clarity and comparability when across different periods. So this is where reclassification and regroupings come into play. So these adjustments, do not change the overall profits or assets, but they make it easier for investor to analyze, compare, and interpret the company's financial performance year over year. So examples could be so common examples that we have seen is that, for example, certain item of income was shown as another income in the audited financial statement, but suddenly the management is of the view that its nature is more in the nature of a non-operating revenue, so then they classify it. So this classification needs to be done in all 3 financial years. So, the only crux is that these changes ensure better comparability and alignment with SEBI's requirements, and, without window dressing. Now, a very important aspect I want to touch upon is that, RFS have to be audited by a peer-reviewed auditor, because a peer-reviewed auditor is required to issue an independent examination report as per the guidance note on report on company's prospectus. Right. And, if earlier financial statements were audited by a non-peer-reviewed CA firm, then SEBI mandates that those financials be re-audited by a peer-reviewed firm. So these can be a major, operational challenge and must be factored in the IPO timeline. Now, what are the common challenges that we see that companies face while preparing, RFS? Let's say one is obviously the complexity of converting from traditional IGAAP to Ind AS. So a lot of companies who have been preparing their financial statements under Indian GAAP and suddenly decides to go for an IPO, then they are required to mandatorily adopt Ind AS, right? So adopting Ind AS in itself is a very tedious task. It requires the companies to the transition can be very technically challenging, requiring careful interpretation of new standards and significant adjustments, right, to reflect the correct accounting treatment. So I would say a company who is planning for an IPO should carefully, assess if an early adoption of Ind AS should be done so as to avoid any last minute, timeline extensions. Technical accounting adjustments, restatements, isn't just about correcting errors, right? It also requires retrospective application of new policies, reclassifications, regroupings, making adjustments to random. Areas that typically require technical expertise, including revenue recognition, lease accounting, deferred tax, share capital changes, EPS reporting, right? So these becomes a challenging task for management. Resource and skill constraints. Many companies, especially those new to the public market, may not have in-house teams with sufficient expertise or bandwidth to handle the detailed requirements of the regulations. So this results in heavy reliance on external consultants, auditors, specialists, right? A process that can be time-consuming and costly. Obviously, the timelines pressures are there on the companies because with every increase in timeline or an extended timeline, the cost of the entire process increases. And then the disclosure requirements, because ensuring that all disclosures and presentation formats meet the SEBI ICI requirements can be very challenging, specifically as regulations and standards are periodically updated. So missing even small details can lead to regulatory queries and delays. And then the stakeholder coordinating between finance teams, auditors, legal advisors, merchant bankers is very critical, right? So misalignment or communication gaps can lead to errors or delays. So, in summary, restated financial statements are not just a formality. They require a disciplined approach, strong technical skills, and meticulous project management. Overcoming these challenges is crucial, not only for regulatory compliance but also for building trust and transparency with the potential investors. Therefore, companies planning an IPO should ideally begin RFS preparation process at least, I would say, 6 to 8 months well in advance of the DRHP time, filing target, so that it gives them enough time for data compilation and sign off, board approval, and banker review, as well as the auditors review. So I think I mean, we are short on time. It's already 4:28. So I think I'll restrict my discussion here. We have 2 minutes. If you want to take up a few questions, maybe we can just open the house for some questions and then conclude. So if anybody has any questions, you can just type in your questions in the Q&A chat box, and we'll be happy to answer those.
I think one question has come, which is so are IPO expenses incurred for OFS reimbursable by the promoter? Yeah. So I think company can raise the invoice on the promoter and recover this amount because that expense doesn't relate to the company. If it is OFS, the expense relates to the promoter. So the company should recover that amount from the
Promoters.
promoter. Yes. So I think
there's a question on, yeah, sorry, please go ahead.
Yeah, that's all. Yeah.
Yeah, I think there's one question that says that do we need to convert all the ESOPs before offer document? So the answer is no, not all ESOPs need to be converted. So anyways, any shareholding that is disclosed in the offer documents is on a fully diluted basis. So whatever are the vested options already forms part of your cap table while computing the percentages. So ESOPs need not be fully converted before filing of offer document.
And there is another question, how the final price is discovered via book building. So this is a question from Charu Garg, right? So Charu, basically, like as a company, along with the bankers, you decide a price range, right? And once there is a price range, then the investor comes and put their bids at different prices, right? Like if the company has sufficient bids at the higher band, right? So that becomes the price. And if the company does not have enough bids at higher price, then whatever is the lower price at which the bids are complete, that is the final price is decided, right? But most of the IPOs happens at the higher band. We have seen in the last recent, like 2 years, only 3 IPOs has happened at the lower band. Hope this answers your question. There are like many questions. I think we are short of time, and we'll try to answer these questions through an email, right? So, but I think we need to close the discussion.
Yes, so thank
We
you.
have your email IDs, I think, so maybe we can email you the answers to your questions. So we have noted down these.
Sure. So thank you, Balwan and Ankit. Those are very enlightening sessions, and I think all of the participants would have immensely benefited. At least it gave a flavor of what IPO is all about. Yes, there will be questions, and that is precisely the point that we at least want to start the discussion and start people thinking on those lines that yes, an IPO is an option that one can look at, not only to raise capital, but to raise reputation, as Balwan said. So I think it's an excellent and very enriching session, and especially the difference between Regulation 6.1 and 6.2. a lot of people kind of get confused as to how a loss-making entity is going for an IPO. And that this difference or this explanation actually clarifies that. So we've had quite a detailed discussion on promoter contribution, who can be considered as a promoter. These are very significant things which companies which are intending to go for an IPO grapple with. And I think this is, as I said, this is first in the series that we want to take up on these capital markets. And I'm sure we'll have the benefit of both Balwan and Ankit taking us through more sessions of similar kind. And happy to answer any of your questions, happy to clarify things. And that's the whole objective of such a webinar. And we look forward to your participation again. And thank you very much once again to the lovely audience. And we've had close to more than 60 participants, I guess, at one point of time. And that just shows that how much of an interest there is when it comes to going public or listing the shares. So thank you very much, Balwan and Ankit, once again. And thank you, participants, for logging in and viewing this extremely important webinar. Thank you very much.
Thank you.
Thank you, everyone.